Today's highlights. As soon as the yen reverses, leverage gives in first. While crypto prices are being slammed, USDT is surging. So is this Bitcoin move really a fake breakout? With strategy facing the hurdle of $2.8 billion in passive outflows, can it withstand the pressure? As Visa and MasterCard restructure payments, will anonymous, convenient, and zero-burden transactions become the optimal solution for everyday use? This recent Bitcoin movement, to put it bluntly, was wrecked by leverage. The price shot up from $870 million to $904 million, looking like it was about to take off, but then suddenly crashed back down below $86,000. In just one day, over $500 million was liquidated. The whole market was highly leveraged, and everyone ended up trampling each other. Right now, what the market is really watching isn't any positive news, but whether the Bank of Japan will raise interest rates to 0.75% on December 19th. History has already given us the answer. Whenever Japan hikes rates, the yen carry trade reverses, global liquidity tightens, and Bitcoin is likely to take a hit. In 2024, there was a 26% pullback, and this year it's already at 31%. Right now, on-chain long liquidations are still increasing, which shows that leverage in the market hasn't been flushed out at all. Before the macro situation settles, the problem with this market isn't with spot trading, but with excessive leverage. Bitcoin is still in a danger zone where it could take another major hit at any moment. The on-chain data is already telling the story. On the Ethereum network, people are using Tether USDT. The number of ERC20 users has suddenly surged to an unreasonable level. The 30-day moving average of active addresses has shot past 200,000, setting a new all-time high. What does this mean? The money isn't just sitting idle anymore, it's moving around on-chain. When stablecoins get busy, it usually means one of two things. Either people are rebalancing their portfolios, or they're positioning themselves in advance. Looking at it now, it seems more like the latter. Funds are frequently moving in and out of exchanges and DeFi protocols, clearly warming up for risk assets like Bitcoin and Ethereum. The key point is that all these activities are happening on the ERC20 network. These are real capital movements within the Ethereum ecosystem, not just sentiment. From past experience, whenever USDT gets this active on-chain, it usually signals that the liquidity environment is improving and the market could ignite at any moment. Of course, it's not quite ready for takeoff yet. It's more like all the money is in place, just waiting for the starting signal. The latest on-chain data, to put it simply, shows that money is really pouring in. Short-term players who have held coins for less than 155 days have ramped up their buying to a historic high in the past 30 days, with the single-day peak reaching nearly 100,000 bitcoins. This level of intensity is rare in the past. It's basically like buyers are flooring the gas pedal. In other words, coins available for sale in the market are being snapped up rapidly by new capital entering the space. Looking at previous cycles, when short-term holders suddenly increase their positions collectively, it usually happens in the middle to late stages of a bull market, or when the market starts to accelerate. At that point, prices are mostly driven forward by new entrants and high-frequency trading. Of course, this type of capital has its own characteristics. They're bold, but not steady-handed. When prices rise, they're the first to rush in. But when there's a pullback, they're also the quickest to run. So while they amplify the upside potential, they also increase volatility. But in the current stage, this result at least shows one thing. Demand is clearly outweighing supply. No matter how much it fluctuates in the short term, the underlying buying power is real, and that's an important reason why the current price can hold up. Please like and follow for the latest updates from the crypto, blockchain, and mining circles 24 hours a day. Click the little bell icon. Join the channel and become a member. Members can claim their wealth password every Friday. To put it bluntly, the current financial market is being forced to change its rules by crypto assets. Institutions like MSCI, which have the authority to set index standards, originally only focused on labeling stocks. But after companies like MicroStrategy started putting Bitcoin directly onto their balance sheets, things changed. The company's stock price fluctuations depend more and more on Bitcoin rather than on making money by selling products. So is it still a tech company, or should it just be considered a publicly listed Bitcoin warehouse? The problem is, this issue comes up when the crypto market is in a slump, and any judgment could influence whether passive funds stay or leave. So this isn't just a matter of classification anymore, it's more like deciding whether crypto assets can truly be written into mainstream financial regulations.
According to the latest proposal based on the data, it could affect 39 publicly listed companies with a total market capitalization of about $113 billion. Once it's passed, passive funds that track the index will be forced to adjust their holdings. It is expected to trigger an outflow of $10 to $15 billion, with strategy being hit the hardest. A single company could face about $2.8 billion in passive selling pressure, accounting for 74.5% of the total impact.
We submitted a detailed letter early this morning in response to MSCI's proposed changes. To exclude companies that have more than 50% of their assets in digital assets, it's an interesting and curious proposal. I have a lot of respect for indexes like MSCI, FTSE, S&P, and NASDAQ, but this one is quite misinformed and misguided, and I'll explain why.
A formal petition opposing MSCI's related proposal has been launched. Multiple industry participants, including NASDAQ-listed companies Strive and MicroStrategy, have publicly opposed the plan, arguing that defining a company's nature solely based on the proportion of digital assets on its balance sheet lacks fairness and could undermine the neutrality that index providers are supposed to maintain.
To put it plainly, January 15th, 2026 is the moment when MSCI blows the whistle. Are you a legitimate listed company or just a shell company hoarding coins under the guise of a business? If the red card is shown, those passive funds that only buy stocks based on index lists will show no mercy and immediately dump shares. For companies like MicroStrategy, which treat Bitcoin as their main business, this could be devastating. This is no longer just a minor bump, it's the first direct challenge from the index rules. The issue isn't that the market doesn't trust you, but that the rules themselves are starting to question whether you still belong in the game. Everyone is still fixated on the wild swings in coin prices. Meanwhile, Visa and MasterCard have quietly updated their back-end systems. They don't care about short-term price fluctuations at all. What they're really thinking about is something much more ambitious. Can they harness the computational power of blockchain's highly efficient and programmable structure? They want to plug it into the current global payment system, just like installing a plugin, without any crashes or having to start over. To put it plainly, in their eyes, blockchain is no longer some foreign species. It's a tool that can be directly leveraged. Although the two companies have different approaches, their goals are perfectly aligned. Whoever locks down the next generation settlement layer first will continue to call the shots in global payments.
Visa has chosen to directly connect to the underlying blockchain, linking its back-end settlement system to the Solana public chain and stablecoins. According to their disclosures, the annualized on-chain settlement throughput has already exceeded $3.5 billion, focusing on providing a highly efficient and low-friction payment clearing path. MasterCard, on the other hand, has taken a more compliance-oriented intermediary approach. Instead of betting on a single public chain, it collaborates with institutions like Ripple and Gemini to build compliant interfaces that connect the traditional financial system with diverse on-chain networks. Both parties are primarily serving high-regulation scenarios such as cross-border payments and business-to-business, and while their goals are aligned, their approaches are clearly diverging.
To put it bluntly, this round of the wealth revolution isn't really meant for users to see. It's like secretly swapping out the engine in the background. Once it's installed, there's no turning back. The approach of MixPay is also very straightforward. No fancy tricks. They just want you to spend USDT as easily as you spend cash. No need for an ID card, no passport, just an email, and you can use it within a day. You don't need to keep a wallet, don't need to touch assets, and definitely don't need to deal with financial management. Whatever amount you transfer is exactly what you get. Clear and simple, no gimmicks. They don't want to be a financial platform, just the most convenient, stress-free payment tool you use every day.
Here, there are legends of getting rich overnight, as well as scams scripted by con artists. This is a dark forest of chaotic development, but it also nurtures the spark of hope leading toward the light. The ultimate destination of faith is freedom. The endpoint of consensus is equality. This episode of TV will guide you through the fog, help you see the future, and together we'll gradually become wealthier.
5,000 pieces of evidence point directly to collusion. Can the Popcom case put an end to the chaos of MEV? With the Fed cutting rates less than expected, yen carry trades are pulling out, and the Christmas vacuum could cause the crypto world to collapse. This July, the crypto community was rocked by a major lawsuit. The Magic Silver coin issuance platform was taken to court. The reason? In short, while publicly claiming that everyone had a fair shot, they were secretly letting insiders cut in line. The plaintiff's statement is straightforward. The platform publicly promoted that retail investors would all start on equal footing with no need for connections. But in reality, they played MEV tricks behind the scenes, manipulating transaction order, and were even suspected of colluding with Solana validators. Internal accounts received priority in packaging transactions, securing the best deals. As a result, ordinary users believed their trades were processing normally, but in reality, they were relegated, receiving only remnants. Due to information asymmetry and slow execution, ordinary users couldn't compete with insiders. In short, this isn't a matter of not being fast enough. It's that the track itself had already been secretly altered.
A U.S. court has approved the plaintiff's motion, allowing them to amend and resubmit the class action lawsuit against the Magic Sound Coin platform. The scope of this lawsuit has expanded significantly. In addition to Pump, related entities such as Solana Labs, the Solana Foundation, and infrastructure company Labs have all been named as defendants. The focus of the case has shifted from the responsibility of a single platform to systemic issues at the Solana ecosystem level.
I think this has been a really interesting perspective in terms of the overall reaction, crypto Twitter to us representing a class of victims here. What I would say is that there are a lot of principles that people discuss that I find that we've generally strayed from in crypto, right?
The revised class action lawsuit has added over 5,000 key pieces of evidence, including a submission from an anonymous whistleblower in September, with the core content being internal chat records of the institutions involved. The plaintiffs claim that these previously undisclosed materials directly document contemporaneous discussions among the relevant parties about cooperation and implementation plans. This provides substantial support for the allegation of collusion and significantly strengthens the evidentiary basis of the case.
The one case is no longer just about a single platform. It's much more than that. It's more like the first time the US crypto community has to directly answer a question. Is MEV actually a legitimate way to profit in the industry or not? Right now, the debate is raging. Some people say it's a technological dividend, while others argue it's just a sophisticated way to fleece retail investors. Regulators are even more baffled. Remember that MEV case in November 2024? The Perel Bueno brothers used bots to make millions of dollars, but the jury couldn't even figure out what a blockchain was. The case was put on hold for further review, but this time it's different. A whole slew of solid evidence has been added, and now the court finally has a chance to clearly define the legal boundaries of MEV. In the end, who wins or loses isn't what's important. What matters is whether the US crypto market will still be able to engage in front-running and arbitrage in the future. It all might come down to how this verdict is handed down. It's really tough in the crypto world lately. Bitcoin has dropped below $84,000, which is about a 30% pullback compared to its peak in October. Ethereum is having an even harder time. Once leverage increases, liquidations happen one after another, like on an assembly line. It looks scary, but honestly, it's not surprising at all. The Fed's move on December 11th was called a rate cut, but between the lines, the message was basically, don't get your hopes up too soon. Meanwhile, our central bank hinted at a possible rate hike. On top of that, with everyone packing up and heading home before Christmas, market liquidity has completely dried up. With all three factors hitting at once, it's no wonder the market tanked. Rather than saying the market itself went bad, it's more accurate to say that both macro expectations and leverage were brought back to reality.
The latest Fed dot plot shows that there may be only one rate cut in 2026, which is clearly below the market's previous expectation of 2 to 3 cuts. Moreover, among the 12 voting members, 3 have already explicitly opposed any rate cuts, causing liquidity expectations to tighten rapidly. At the same time, the market sees a high probability that the Bank of Japan will raise rates by 25 basis points to 0.75% on December 19th. That probability is close to 94%. If it happens, it will mark Japan's highest interest rate in nearly 30 years.
With the Bank of Japan set to hike interest rates again on December 19th, Bitcoin's recent sell-off is expected to worsen.
For a long time, global arbitrage funds that have relied on low-interest yen, especially the hundreds of billions of dollars in the crypto market, will face pressure to close positions and repatriate funds back to yen. Historically, when the Bank of Japan raised rates in August this year, it triggered an 18% single-day plunge in Bitcoin. The current macro environment is once again putting significant pressure on crypto assets.
The current market is a bit like a highway at night with no streetlights. Once December 23rd arrives and North American institutions go on holiday, there will be half as many buyers left to take over positions. With such thin trading, even a slight breeze can send prices off course. On top of that, the Bank of Japan is about to raise rates, and the Federal Reserve is reluctant to inject more liquidity. With these three factors stacking up, it's hard for the end of this year not to be volatile, but this isn't the end of the bull market. It's more like the market is switching to a new set of liquidity rules and learning to walk again. Right now, the most important thing isn't trying to guess the bottom, but rather waiting for the Bank of Japan to make its move and seeing whether the money comes back after the holidays. Only those who can survive until then are qualified to talk about the next round of the market.
Michael Saylor's point is very straightforward. Bitcoin dropping from 100,000 to 87,000 doesn't look good. But underneath, upgrades are quietly happening. Regulation is no longer being recklessly enforced, institutions are starting to seriously allocate, and banking and accounting rules are finally siding with Bitcoin. These are the foundational projects that can truly bring Bitcoin into the global mainstream system. The price is just moving a bit slower, but the path is actually more stable. To put it plainly, in this market, everyone is just going their own way. The bulls and bears in the market are no longer on the same wavelength. Doge became the one singled out, dropping 7.24% in just 24 hours, and even hit a new weekly low along the way. Short-term funds have either exited or taken their losses as needed. The mood is clearly on the cold side. Police in Beijing, Zhejiang, cracked a virtual currency fraud case where the suspect lured the victim into investing 3 million yuan to buy fake virtual currency. After so-called offline transactions, the funds could not be withdrawn. Aptus is taking a bit of a precautionary approach this time, directly putting quantum computing, the future boss, into their roadmap. The AIP 137 proposal makes it very clear. First, implement quantum-resistant signatures at the account level, just in case quantum computing really matures one day and the old encryption algorithms get instantly cracked. This move by Base is basically like adding more lanes to expand the chain. BaseBuild officially announced that the block gas limit is being raised to 375 million, so each block can fit more transactions, making congestion less likely. Simply put, using Base in the future means it's not so easy to get stuck spinning in place anymore.
The essence of the crypto world today is actually a long-term game where patience hedges against impulse. Wealth always slowly flows from the short-sighted to the long-term thinkers. Those who chase when the market rises and panic when it falls may seem hardworking, but in reality, they're just working for the trend. The ones who truly make big money are never the ones who trade the most frequently every day, but those who know when to hold, when to endure, and when to do nothing at all. When the market is good, get in early before consensus is formed. When the market is bad, be able to hold your position steady amid the loudest noise. Looking back, you'll realize that what determines your returns isn't some miraculous single trade, but whether you manage to fully capture a trend. Time will keep filtering out the impatient and rewarding those who can endure. Those who can wait and endure. Time is the ally of the trend and the nemesis of speculators. If you understand this, please like us. That's all for today's main content. Our channel focuses on valuable news summaries in crypto, blockchain, and mining. We provide news updates and in-depth special reports. If you find our channel valuable, share and follow us. You can also become a member. From Monday to Friday, members receive exclusive wealth codes. Let's add a zero to our assets in this bull market. See you tomorrow.